Welcome back to another Market Insights. We are switching things up for 2024 and bringing on a repeat guest, Jeremy Schwartz. He's the global CIO at WisdomTree, and he's also co-author of Stocks for the Long Run. Last year he came on in our show in 2023 when the market was getting overly bearish, and he actually said this.
You're going to have sluggish, you're going to have a pickup in the unemployment rate. And we do think you could see unemployment rising this year, but actually still have positive real GDP. And you say, well, how does that math work? Last year was a disaster for productivity, and we think productivity could rebound this year, but we think productivity trends will rise as firms cut their marginal workers. In my view, it's not an expensive market, 17 to 18 times forward earnings. We think fair value for the S&P is 20. But in general, you'd probably say we're constructive on stocks and bonds this year. Certainly from the Siegel worldview, very constructive on markets.
So Jeremy, you brought your crystal ball with you last year. Hope you got it again this year. Thanks for joining us.
Thanks for having me. If only we could do it like that every year.
That would be nice. Hopefully you got it now. So let's just pick up right where we left off from the call last year, which was broad economic data. A lot of talk about where we are in the business cycle. What are you seeing now in your expectations for GDP growth in 2024?
Well, our big story last year was you had a disastrous productivity year that was going to rebound from the lows. And that materialized exactly as we thought in some ways. I mean, the productivity side of the equation did exactly what we thought. We thought we'd get a big rebound. Our big picture view, though, is that this is not a one-year trend, that this is, if you go look for the next 5-7 years, that we have a higher structural productivity scenario on our hands. And so our own estimates of real GDP growth over the sort of call it medium term have ticked higher. Now, last year, we thought you could actually have a scenario where you lost workers and had positive real GDP. That ended up being too bearish on the economy. You didn't lose workers in aggregate. We actually had half the number of people worked in 2023, or new workers, half as many new entrants in 2023 as we had in 2022, but we had more than double the GDP growth. I think this could be the year maybe you do see a negative on the payrolls net, but still have positive real GDP. That GDP is actually offset again by higher productivity, and part of that is you can't go anywhere without hearing AI. AI is the buzzword of the day, and last year's productivity wasn't AI in our view. I mean, it was just the bounce back from the historical lows. We do think you'll have, when I talk about 5 to 7 years, that is one of the things that we think will contribute over the longer run. And I think we're going to see more and more examples of that. I'm hearing that from even one of the big Magnificent Seven companies. I'm hearing that they're going to reduce a big part of their sales force and using AI instead. And we'll see how big that comes across other organizations. But I think you'll see more of those anecdotes come out this year.
So last year the discussion was soft landing, hard landing, and you actually threw out, you said, you don't really follow those terms. You said no landing, which was the right call for last year. Where would you put the 2024 economy?
It's been amazing how resilient we have been to these higher rates. You really haven't seen big pressure. And I can say in the most interest rate sensitive sectors, housing, number one, you haven't seen as much of softness in that market as you might expect by mortgage rates that are sort of double where they were prior to the hiking cycle. And you can say now the home prices, like the Case-Shiller home indexes, have been very strong and resilient to these higher rates. Will you start seeing the pain of higher rates come in? It's possible you start to see a little bit more of that. But I think we've just been resilient. So I'm going to stick with the no landing. I mean, we think we've been able to withstand it. Now, the key, what's really important is if we came into the year, we thought one of the key risks was you could have softness in the economy. We'd start losing jobs, but the Fed would be inflexible and say inflation is still a top concern. They say, oh, we got this risk of the 1970s, 1980s. We can't lower rates. And what happened at the December meeting when they put three dots to cut for this year, it changed the tone. And it was like, we can be flexible. If the economy weakens, we will adjust. Now, we're broadcasting on a day where you've got statements on the tape. It's a Goldilocks economy. We've been using the word Goldilocks, not too hot, not too soft, right, just right for the Fed. And I think you're hearing that from the Fed, but they're not going to be in such a hurry to cut rates unless it weakens. If it weakens, they'll adjust. But they took off the table that they would be so inflexible. And so I think that was to us one of the big positives for the market, is that you don't have to worry about them overly keeping too restrictive on this, what we call false narrative of the 1970s, is that they're going to be flexible if things get worse. And so that lowers the probability of recession. It doesn't mean we're completely avoiding recession, but it lowers the probability. And so that was a key thing that got us to upgrade some of the more risk sensitive parts of the market that were priced for recessions, things like that.
So you said the Fed has 3 expected cuts in their dot plot that they released. Then you have the Fed futures market pricing in 6 or 7, but if you talk to an equity investor, they usually think it's somewhere between there, probably not 6 or 7. So how are you assessing risk there in terms of what's actually priced in the market in case the Fed does not actually come through with cuts?
This is a very important point about how those futures markets work. And it actually goes to like what's actually expected versus what's priced into the market. And when we say that, these markets, you can't take the pricing of the market for where the futures are going to be at the end of 2024 and say that's what the market expects. And the reason is these are not what we call unbiased estimates. People say if things go really wrong, they're gonna have to cut a lot. And so what ends up happening is it's one of the better hedges for things going really wrong. And so it doesn't mean that this is what people expect. It'll just bias the numbers higher because it's being used as this called a negative beta asset. So it's a hedge asset that people buy. And so what they actually expect may be exactly what you're saying, that it's somewhere, maybe it's 1 to 2 cuts that get priced in as a result of that hedge asset feature. So you can't take it literally. You can't interpret those numbers literally. You have to price some of this hedge asset feature to it. But one of the things that we think people also miss on this pricing of the futures is people say if we don't get the 5 to 6 cuts, we're going to be really disappointed and the equities are going to sell off. And we say that's completely wrong. We say we could actually have a good market if the Fed does nothing. And the reason they're going to do nothing is the economy is actually strong and earnings growth is probably going to be strong. So you don't need the 3 to 5 cuts to actually have a good market. Yes, it's priced into the market today, but you say under what scenarios are they not cutting? It's because GDP growth continues to be robust. They're not really laying off people. Productivity is coming fine. Margins are coming fine. And so you'll probably have a pretty decent earnings outlook, and you'd still have a reasonable market under that scenario.
Out of that, you talked about the Goldilocks economy on not too hot, not too cold. Something else we've always heard over the last decade is that good news is bad news is good news for the market. So kind of alluding to that, I believe, is what you're getting at. If we do not see a bad market and we start to see this change in interest rate expectation, could that be some bad news for the market valuations then?
Yeah, it's always, there's like sort of anything about a present value of future cash flows calculation. There's the earnings and the cash flows in the numerator, and then the denominator is the discount rate. And what multiple are you going to put on those earnings gets, depends on your cost of capital and how high interest rates go. So it's often they're interrelated. It's like if you're going to lower the rate, it's because it may be because you have weakness in the economy that's going to impact cash flows. And is your cash flows impacted more than the discount rate? Is which wins the battle of the numerator denominator? Now we think we're at a reasonable multiple for the market. It's right around 20 times earnings for the S&P. That's a 5% earnings yield. And the way we come up with our sort of forward expectations, sort of let's say our 7-year expectations, is you take the 5% earnings yield, you add a 2 to 3% inflation, you're talking 7 to 8% nominal returns for the S&P. That's a pretty reasonable real return when your alternative, your TIPS yield. So stocks are real assets, earnings grow with inflation over the long run. Companies raise their prices as their input costs go up. And so you see earnings and dividend growth ahead of inflation. And so the 10-year TIPS yields are like 1.8, so you still have over a 300 basis point equity premium, stocks versus bonds. And so it's reasonable. And so in today's market, will the multiple rise or compress, right, depending on what's happening to those rates? We think it's right about fair, so we don't think there's a lot of expansionary room. And so the cuts, we don't think it's going to really lift multiples. I mean, it's sort of at a fair multiple. So it's going to really depend what happens to earnings growth will dictate the long-term, the sort of performance of the markets there.
So good headlines are going to offset the fact that interest rates are going to stay where they are, or vice versa. Bad headlines would say interest rates, so the multiples, either way that you get to that 20 multiple PE.
That's what we think is the longer term fair value, and sort of things can get, depending on a certain dynamic, if sentiment's going hot, multiples can go, in the tech bubble, they got as high as 30 back in 2000. Now, but at that time, TIPS yields were 4%. So it was a time to really go long TIPS and be out of the market when you had a 3% equity premium, 3% earnings yield, and a 4% TIPS yield. You're nowhere near those levels. We don't think we're going quite back to those levels. But sort of 20 is a nice fair multiple.
So something that could change potentially your view. I'm curious, your colleagues actually just posted the slide about the 2024 election. It's an election year. Jeff Weniger threw up the slide going back to the 40s, talking about when an incumbent runs for re-election. You really don't, obviously it's a very small sample size. You've had positive years since the 40s every time this has happened. Do you bring politics and election years into any of your forecasts?
Not really. I mean, there's people watch it. There's fun to talk about. There's another seasonal chart that goes around. I was just looking at this morning. Was in the quarters, like the Q1 of these 4-year cycles of the fourth year of the presidential cycle is the weakest, and then the last 3 quarters, the second quarter is the best. All these are sort of interesting seasonal time periods people talk about. I do think this is the year where we're going to be focused on the Fed to focus on geopolitics. And, we're coming off of just the Taiwan election. I mean, that you talk about an election that can have big implications and consequences is, the regional conflict. We have the Russia-Ukraine dynamics, and there's like, well, will they have a ceasefire? Will they have a resolution in Europe? That's very top of mind. Obviously, we have all this stuff going on in the Middle East, and that's certainly one of the open question marks is, will they keep disrupting these supply chains? And will that cause some inflationary pressure and just slowdowns because things all, they have to start rerouting all the ships that going through the Suez Canal and the Red Sea? That's a source of risk. But the China-Taiwan issue is one of the big issues. And they sort of reelected the current DPP party, which is a little bit more pro-independence party. And that obviously doesn't make Beijing and Xi Jinping happy. Now the question is like, what are the long-term implications of that? China keeps saying they're going to reunify Taiwan, and what is the U.S. role in all of that? To the extent that we have our election later and we have different policies on all these issues, that's going to be one of the big open questions: is this conflict with China over time, and the interconnectedness of China into the global economy can't be understated. So I think it'll be fascinating. That's, to me, the big wild card of all the geopolitics is what's going on, U.S., China, Taiwan, how that all plays out. And I think, we don't think there's a war risk today, but those sort of long-term tension is there. And certainly there is a risk of things escalating at some point in time.
Well, let's tie that together on asset allocation. Maybe that's playing into an underweight you have in emerging markets. We'll throw up on the screen your asset allocation chart for where you see things at neutral, negative, or positive. And it's showing negative at large cap growth and positive on value, mid and small cap, along with developed international small cap. But you actually have negatives on developed international and emerging markets. What went into these, and what are you kind of forecasting to see from this?
Yeah, I mean, in some ways, we talked about the PE ratio as one of our long-term asset allocation guides, sort of real returns. And you'd say, hey, China looks like it's one of the cheapest markets. Why aren't you adding to that? And I think some of that does stem from this geopolitical risk of where we, if anything, have been more cautious there and wanted to go into sort of ex-China type concepts, or tilting weight to be underweight China when we go there. But part of that view was, you could get emerging markets at 12 times earnings, which is much lower than the 20 times earnings for the S&P, but you could get US small caps at 12 times earnings. And, you know, I started off saying that with the Fed discourse made us say the probability of recession is lower than we came into December. And that is completely tied to us upgrading our small cap value point of view. So small cap value, we think, was priced for recession, lower probability of recession, has us wanting to lead into small cap value and going overweight that a bit. And you know, it's not like we were sacrificing the overall multiples on the portfolios. I mean, one of the reasons why you go to the developed world in EFA or emerging markets is, hey, they're much cheaper than the US. So global diversification, you get much cheaper stocks. But you don't have to take that risk to get similar multiples with that small cap value. So I think that was largely the story. When we reduced some of our developed world and EM in favor of the US, it wasn't like we were buying sort of the richly priced Magnificent Seven. We went into some of these sort of broader, lower valued small cap stories in the US. I do think, you know, when we were coming up with our themes for our portfolio to describe our tilts, you know, I talked about how I think the productivity of the economy is real, AI is real. And so like we have some sensitivity to, or sympathy for the story that the AI story is going to have a real meaningful economic impact. And we do think there's going to be many places that benefit as a result of that. But I think as we build these well-rounded, diversified portfolios, the dominating theme was sort of broader participation in the rally this year. And so that's where we sort of are tilting towards that small cap side.
Yeah, whenever we were looking at our allocation relative to what you have here, we line up very similar with, I would say the difference is we're not overweighting large cap value. We're more neutral, maybe a little bit more overweight to the growth side. And I think it's that interest rate story for us. If we do think that the expectations are realized or even what the market expects, you wouldn't want to be underweight growth because of the way that's going to hit the discounted cash flow model. What are your thoughts on our approach?
I understand. Listen, these Magnificent Seven or just the quality tech stocks in general. I mean, I've been doing some work on just the accounting nature of intangible asset investments and all their big R&D investments, and how if you just account for what they treat as research and development, they expense immediately. If you were to capitalize those expenses on their balance sheets and then depreciate them over a number of years, like you do if you were to build a plant, where you make an investment, you build the plant, and then you depreciate. If you treat R&D in a similar fashion, the multiples come down dramatically, and the premium isn't like on the traditional PE metrics. It's like a 27 or 28 PE versus a 17 PE. So there's a 10-point premium for tech versus non-tech. When you do this other form, the multiples compress almost in half, like in terms of the premiums you're doing. So I understand and think there's a big case for that. I do believe in the AI story. It's real. So I think we just made a choice to lean into the broader participation in value, but I understand the case of how important these tech stocks are, and they still have a lot of tailwinds at their back.
So we had reviewed your crystal ball, and you were quite accurate last year. We deal a lot with the retail investor, and you know the story of value rotation is one that's tired. What would you say if you were sitting in front of a retail investor on why it still makes sense to go value, even though that hasn't played out in a while?
Well, this comes back to my long-term research with Dr. Siegel. You know, I've been working with Professor Siegel for the last 20 plus years. And when I first started working for him, it was right in the aftermath of the first tech bubble in 2000. And we did a lot of research on the long-term strategy. Now, value's underperformed for 17 years, almost since the beginning of Wisdom Tree when we first launched. So we've been in a brutal bear market for value versus growth. Growth is definitely won the day. But, you know, when you think real long-term, so we did a study of IBM versus Exxon that goes back 70 years. And if you look at Exxon versus IBM won over 70 years by like 3% a year on sales growth, on earnings growth, on dividend growth, every growth metric. It was 200, 300, sometimes 400 basis points a year ahead of Exxon. And you say, well, why was Exxon the better investment over those 70 years? It's because IBM traded at a 22 times earnings and Exxon traded at a 12 times earnings. IBM had a 2% average dividend yield. Exxon had a 5% average yield. And to me, that's like the story of the S&P 500 versus high dividend stocks today. High dividend stocks today have a 12 PE and a 5% yield, exactly what Exxon had for the last 7 years. The S&P 500 is exactly IBM. It's 20 times, it's a 2% below yield. And so I think you can make a lot of parallels between, yes, the S&P is going to have better earnings growth than high dividend stocks, probably by about 3% a year. But the 12 times earnings on average for those high dividend stocks over the real long run, I think can play out. And so I think there is that long-term nature. But hey, it's been a 16-year bear market for value, so I understand people being frustrated. But it doesn't mean some of these principles should be really abandoned.
To close out asset allocation, we have to go to bonds, fixed income. What is your forecast for correlation in terms of if there is an equity sell-off, do we get protection with bonds, or do we keep moving in the same way, it seems like?
Well, the word you use, correlation, is the critical word right now. And to us, this is one of the things that are keeping long bond yields a little bit higher than we might have expected even 2 years ago. Okay. And so, right now, the 10 years right above 4%. We got up to 5% not so late last year. We think it's going to drift higher, but in the short run. But at 4%, this is sort of where we think the long-term level settles. Like, we don't think there's a case to be adding a lot of bond duration to portfolios today. You can get 5.5 effectively with no risk. Essentially, you get 1 week floating rate treasuries. It's right around 5.5%. You have to sacrifice 150 basis points to lock in for 10 years. Part of that is because people think the Fed's gonna be cutting rates and you're not gonna be able to get the 5.5% forever. But if you want to lock in duration for 10 years, you're going all the way down to 4%. That 4% is where we think it should settle to over the long run. And that comes from saying at this sort of equilibrium level, longer term level, the Fed should get down to around 3.5. And that you should have, instead of a inverted yield curve where you have the long end 150 basis points below the short end, you should really have a more normal yield curve of 50 to 75 positive. And so, you should have the Fed funds at 350 or 325 to 350 and the long end at 4, maybe a little bit higher. And so, you could actually pick up yield by staying short duration. And that's one of the better diversifiers. I mean, you don't have a lot of volatility. In bonds, if the 10-year went back from 4 to 5, you would still have some price losses there. Now, at 4% starting yield, it's much different than when you were starting the yield at 1%. So your losses aren't going to be like you had the big bond bear market in 2022, and earlier. But I'd say the rising correlation, is a key factor that's going to keep these rates higher. There was a paper that we quoted, and then I've just done some work over the last 40 years. When you had a positive correlation versus a negative correlation between stock and bond prices, the average yield differential was like 300 basis points. There was a really big difference between when bonds were acting as a good hedge to stocks, and bonds aren't acting like that good hedge anymore. So, that memory of inflation, when you have inflation, bonds don't serve as strong of a hedge. You need to look for other things. The dollar is actually one of those things that has become much more negatively correlated, and is very interesting thing to think about as what can offset it. But bonds aren't serving their role. It's one of the reasons why we think yields have this sort of longer being higher because of that correlation. Now, of course, there is a yield level where they can become a good hedge again. But we think that memory is going to be with us for a little bit extra time here.
Great. Well, let's close out with the same game that we played last year, which was select an asset class or sector that you think is going to perform the best in 2024. And last year, no one predicted AI. We did not get that one. But other than that, predictions were still pretty good. Go to you first, Aaron. What do you got for 2024?
I would say small cap gold. I do think that the Fed is going to continue to lower their interest rates to expectation. I think inflation will be higher than what their target rate is. So then we'll see a drop in the dollar. So I think it'll favor small cap, and I think it's also not priced in, and gold will appreciate as well.
As technicians, we're ready to make quick changes. So
yeah,
obviously
absolutely.
when we say things, so I'm sticking with what we said, which was in the past status quo. So I'm sticking with large cap to enter the year, but I do like the setup very much for small cap value, so be ready to make some changes there for a little bit more broadening as well. Jeremy, what are you picking for 24?
I'll give you an unloved sector that's starting to show some strength in Q4, but we talk about the beneficiaries of AI that's sort of unloved, and I'm going to go with sort of biotech. We have an ETF, WDNA. It's our Biorevolution Fund. There's the author Jamie Metzel. He's got a new book coming out in June called Super Convergence: How All the AI Technologies Are Going to Lead to a Lot More Discoveries in biotech space. And this is a strategy that goes beyond just the healthcare sector to sort of think about the food implications, energy implications, eventually data storage implications, because DNA is very good at storing data. And so there's a lot of interesting dynamics happening there. And it definitely turned around recently, had 3 negative years in a row for biotech. I think it becomes part of the AI story. And I think it's starting to show some strength. So that's my contrarian AI play for 2024.
Bold prediction. That's everything I had.
All right. Thank you for joining us, Jeremy. If you haven't done so already, hit that subscribe button. We're only sending these out monthly, and I want to make sure that you can get that information. And Jeremy shared a lot of information with us last year and was right, while consensus was wrong. So if you enjoy his commentary, make sure you hit that like button, and your friends certainly need that advantage as well. Share it while you're down there. Thank you.